Welcome to our deep dive on Roth conversions and why they can be a high-stakes bet. In this video, we will explore when converting traditional IRA or old 401k money to a Roth IRA makes sense and when it can be financially damaging. We will focus on taxes, timing, and strategy to help you think critically before acting. First, we will define what a Roth conversion is. Next, we will clarify why conversions are fully taxable in the year you do them. Then, we will challenge the common myth that Roth is always better. After that, we will pinpoint the sweet spot for conversions, usually during unusually low-income years. We will follow with a bracket-filling strategy, highlight the advantage that conversions do not count towards annual contribution limits, walk through a decision checklist, test your understanding with 2 quick quizzes, and finally wrap up with key takeaways and a disclaimer. Before we jump into details, remember that a Roth conversion of pre-tax money is a 100% taxable event. The full amount you convert is added to your current year income. So while the promise of tax-free growth is real, the cost is immediate and potentially steep. This is what makes the decision high stakes. Let us define the conversion. You move money from a traditional IRA or old 401k, both pre-tax accounts, into a Roth IRA. In exchange for paying tax now, your future qualified withdrawals from the Roth can be tax-free. The catch is the conversion amount is taxed at your current marginal rate. If possible, it is best to pay that tax using cash from outside the IRA so the full amount remains invested for growth. This flowchart helps drive the decision. First, compare your current marginal tax rate to your expected effective rate in retirement. If your current rate is higher, a conversion right now is less attractive. Second, determine whether you have outside cash to pay the tax. Without outside cash, converting often reduces the capital you keep invested. Third, ask whether this is an unusually low-income year, such as a sabbatical or a gap between jobs. Fourth, consider whether a conversion would push you into higher tax brackets or trigger phase-outs and surcharges like Medicare, IRA. Based on these answers, the outcomes range from a strong yes to a cautious, partial conversion that fills only lower brackets, or a likely no, where you wait for a better opportunity. Now, let us focus on the tax impact. A conversion adds the entire amount to your income in the year you execute it. That can push you into higher brackets and may reduce credits or trigger additional costs such as Medicare, IRA surcharges. Since many retirees have lower effective tax rates in retirement than during peak earnings, converting in a high-income year often results in paying more tax than necessary. Therefore, timing is critical. Next, here is your checklist. Estimate your current marginal tax rate. Then estimate your expected retirement effective rate. Identify any unusually low-income years where you can fill low brackets with conversions. Confirm you have outside cash to pay the tax bill. Model effects like bracket creep, Medicare IRA, and the loss of credits or deductions. Consider the Roth 5-year rule for conversions, which can affect accessibility. Decide whether to do partial conversions to fill only the lowest tax brackets. Finally, reevaluate each year, as both your income and tax law may change. Then, use a bracket-filling framework. At lower brackets, such as 10 or 12%, consider filling up to the top of that bracket if you can pay taxes with outside cash. In the middle brackets, like 22 to 24%, proceed cautiously and compare to your expected retirement effective rate. In high brackets, such as 32% or higher, conversions typically do not make sense unless there is a special circumstance, such as expiring net operating losses or unique planning windows. Now let us compare. Converting now can start tax-free growth sooner, is most useful during low-income years, consolidates old accounts, and takes advantage of the fact that conversions do not count toward annual Roth contribution limits. On the other hand, waiting avoids a large current tax bill, may result in paying a lower effective rate in retirement, reduces the chance of triggering IRA or credit phase-outs, and preserves flexibility if future tax brackets change. Moving forward, visualize income across life stages. Early career often has lower to mid-level income. Peak earnings years typically bring the highest marginal rates. A sabbatical or gap year, or early retirement before required minimum distributions, may be low-income windows that are ideal for conversions. Finally, Retirement may feature a lower effective tax rate, making high-rate conversions earlier in life less compelling. Quiz time. If your current marginal rate is higher than your expected retirement effective rate, what is usually the best move? Option A. Convert everything now. Option B. Wait or only convert amounts that stay within low tax brackets. Option C. Convert only if you can pay taxes from the IRA balance. Option D. Convert regardless of brackets because Roth is always better. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to wait or only convert amounts that remain within low tax brackets. Paying high marginal rates now, when you expect lower effective rates in retirement, is typically inefficient. It is a myth that Roth is always better. Mid and high earners commonly face 22% or higher marginal rates during peak earnings. Many retirees, however, pay lower effective rates on withdrawals. That means converting too early at high rates can be a poor deal. Strategy, not impulse, should drive the conversion decision, especially by targeting unusually low-income years. This illustrative pie chart shows the idea of filling lower brackets with a partial conversion. A portion of income fills the 10 and 12% brackets. Some touches the 22% bracket, and the upper brackets remain unused. The goal is to stop conversions before pushing into higher, less favorable brackets. This is a simplified example for illustration only. Always model your own numbers. Second quiz. Which factor most strongly signals a good year for a Roth conversion? Option A. You received a big bonus and are in a higher bracket than usual. Option B. You are between jobs with unusually low income and have cash to pay taxes. Option C. Your portfolio had strong gains this year. Option D. You want to consolidate accounts regardless of tax impact. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that being between jobs with unusually low income and having cash outside the account to pay the taxes is a strong signal. This lets you use lower brackets efficiently without shrinking your invested balance. An important advantage is that conversions do not count toward your annual Roth contribution limits, allowing you to move larger sums when appropriate. This can provide a powerful boost if executed wisely. Best practice is to pay the tax from outside funds so the full converted amount remains invested. Also, remember the 5-year conversion clock before accessing converted amounts penalty-free. To summarize the most important points, conversions of pre-tax funds are fully taxable in the year you convert. Roth is not automatically better. The outcome depends on timing and your tax brackets. Target unusually low-income years to fill lower brackets. Use outside cash to pay the tax, and avoid reducing principals. Conversions do not count toward annual contribution limits. Finally, model all impacts, including brackets, IRMAA, credit phaseouts, and the 5-year rule. As we wrap up, do not let the desire to consolidate accounts override the tax analysis. Always compare your current marginal rate to your expected effective rate in retirement. Aim to fill lower brackets in low-income years and avoid converting at high rates during peak earnings. Reevaluate every year as your situation and tax law evolve. Before we close, note that this content is educational and not tax, legal, or investment advice. Consult a qualified professional for guidance tailored to your situation. Examples are simplified and illustrative, and tax laws change over time. Thanks for watching. If this helped you think clearly about Roth conversions, please like the video, share it with someone who appreciates careful tax planning, and subscribe for more evidence-based finance content. Tell us in the comments how you are planning your conversion sweet spot.